Yesterday, we did see the increase of the monetary policy rate by 50 basis points to 26.75%. I believe we have details of the decision by the Central Bank of Nigeria at the back end right there. So let's take a look at the decisions that the committee came up with. And the Monetary Policy Committee of the Central Bank of Nigeria voted to increase the benchmark interest rate by 50 basis points to 26.75%, as well as adjust the asymmetric corridor to plus 500 basis point and minus 100 basis point, from 100 plus 100 basis point to minus 300 basis point. The committee also decided to retain cash reserve ratio for deposit money banks at 45%, as well as keep the metric for method banks at 14%, as well as retain the liquidity ratio at 30%. Let's take a glimpse into, the decision by the CBN. Let's take a look at the briefing by the Central Bank of Nigeria governor at the end of that meeting.
The Monetary Policy Committee, MPC, of the Central Bank of Nigeria, CBN, held its 296th meeting on the 22nd and 23rd of July 2024 to review recent economic and financial developments, as well as assess risks to the outlook. 11 members attended the meeting. Decisions of the MPC. The committee's decisions are as follows. 1. Raise the MPR by 50 basis points to 27.65% from 26.25%. Adjusted the asymmetric corridor around the MPR from plus 100 to minus 300 to plus 500 to minus 100 basis points. Retain the cash reserve ratio of deposit money banks at 45% and merchant banks at 14%. Retain the liquidity ratio at 30%. Considerations. The committee was mindful of the effect of rising prices on households and businesses and expressed its resolve to take necessary measures to bring inflation under control. It re-emphasized its commitment to the bank's price stability mandate and remained optimistic that despite the June 2024 uptick in headline inflation, prices are expected to moderate in the near term. This is hinged on monetary policy gaining further traction in addition to recent measures by the fiscal authority to address food inflation. In its consideration, the committee noted the persistence of food inflation, which continues to undermine price stability. It was observed that while monetary policy has been moderating aggregate demand, rising food and energy costs continue to exert upward pressure on price development. The prevailing insecurity in food producing areas and high cost of transportation of farm produce are also contributing to this trend. Members were therefore not oblivious to the urgent benefit of addressing these challenges, as it will offer a sustainable solution to the persistent pressure on food prices.
And that was the Central Bank of Nigeria Governor Olayemi Cardoso at the conclusion of the Monetary Policy Committee meeting, which ended yesterday. But I'm joined now by my guest, who is an economic analyst, Dr. Samson Simon. Thank you, Doctor, for joining us on Business Daily today. Okay, Doctor, I would like by hearing your point of view on the aggressive rate hikes we have seen so far, especially this year. Since the start, I believe it was February 2024, and put together we have seen approximately 800 basis points since February. But I will like to hear from you now. What is your assessment of the economic policy changes by the Central Bank of Nigeria, again hiking the interest rate to 26.75%. How would you say this will impact on the Nigerian economy currently and the business environment as a whole? We seem to have some technical challenges there, but let us go on a short break. The conversation continues after the break this day. And you're still watching Business Daily, coming to you live on Trust TV. My guest, who is Dr. Samson Simon, is still with us on the program. Doctor, I would like to again, start the conversation, hearing from you as to how the 50 basis point hike will be combating inflation and combating, the challenges that we're facing in the foreign exchange market.
Well, the central bank has taken a mortgage, and last hike by the near basis point is less mortgage compared to previous hikes, and the objective is to tackle inflation. Sadly, we have not seen much, but the truth is, while monetary policy is a necessary tool to tackle inflation, it may not be sufficient. Let's look at the causes first. What brought this high inflation? We're talking about 34.19% headline inflation, according to the data that came out from the National Bureau of Statistics. For June, data for inflation for June, 34.19%, which is far from our target. The target is 6.9%. What really caused this inflation? Let's start with the recent reasons. The devaluation or the depreciation of the naira, right? And then the removal of subsidy. So there's a need for us to reverse some of these things. If the naira has been devalued, how do you make it to be a better value? If it has depreciated in value, how do you make it appreciate in value? Then for subsidy, the subsidy itself is not the issue. The issue is that the price of the farm fuel has climbed. What do we do to ensure that we have enough supply of the farm fuel such a way that the price can come down? So these are some of the things that we have not largely done. And then talking about insecurity in the food belt of Nigeria, have we tackled insecurity there? So the central bank has been hiking rates as aggressively as it wants to. That in itself is not enough. Then bearing in mind too is that monetary policy has long and variable lag. It's not like automatically being translated. By hiking interest rates, it doesn't translate automatically to crash at the rate of inflation. So many factors have to come into play. And with this hiking now, the cost of credit was high before the hiking, but now it's even going to be higher, at least by 50 basis points, by half of percentage points. The cost of credit, which will discourage businesses from accessing credit, also discourage individuals from accessing credit. And even for people that have taken loans for, the cost of paying will still go higher. So it's going to be very difficult for those people to pay back. So that's implication of this high monetary policy.
Interesting perspective right there. But I will like for us to also touch, on the asymmetric corridor. We also did see the adjustment of the asymmetric corridor from plus 100 and minus 300 to plus 500 and minus 100. Interestingly, we didn't really get, a valid reason as to why, that change occurred. The Central Bank of Nigeria governor didn't say exactly why. But could you explain the implications of the adjustment, especially for commercial banks and their borrowing behavior going forward?
The central bank has been embarking on contractionary monetary policy, which is counter-cyclical, which is advisor in economics. And apart from hiking interest rates, in the last case, at the last MPC, they hiked it by 50 basis points. They have also tinkered with the asymmetric corridor around the MPC. And what's the implication of this? The asymmetric corridor looks at the standing lending facility and the standing deposit facility. The central bank lends to banks. And what does it charge those banks when it lends to them? So the MPC plus 100 basis points. But now with the increase from 100 basis points to 500 basis points, meaning that there will be more interest accumulated if the deposit money bank or a financial institution approaches the central bank. That will mean that those banks are paying more to the central bank. So it's a bit to discourage those banks from lending from the Central Bank of Nigeria. Then if you look at the other side of the asymmetric corridor, it was minus 300. And now they have added 200 basis points to make it minus 100. So what does it mean? In the past, should you allow your money to be kept in the central bank, what would be accruing that funds to be reduced? So this is all in a bit to encourage these deposit money banks to keep a lot of their money in the Central Bank of Nigeria. Because the MPC was 26.5, right? And it was minus 300 basis points. So that would be 23.25. Now that it is 26.75 and it's minus 100 basis points, 25.5. So that means you are attracting more money by keeping your money with the central bank. So more banks would like to keep their money with the central bank. All this will encourage less liquidity within the system. But the truth is, the central bank has been as aggressive as it can be. The fiscal authorities have not been embarking on contractionary fiscal policy. The fiscal authorities have not done enough to meet the monetary authorities' output. They have, in fact, been doing which is pro-cyclical, because our budget is, we have a budget surplus, which is clearly an expansionary fiscal policy. So I think they're actually working at those purposes. So it's going to be very difficult for us to see results very soon.
Okay, from what you've stated, you're saying that there is the lack of synergy between the fiscal and policy sides. But let's hear from you now what the impact this will have on the real sector. Some analysts are saying that there are concerns around, how these will affect, the real sector players, especially due to the increased recent interest expenses on debt funding. But how significant do you think this impact will be on Nigeria's real output growth, especially for the remaining months of 2024?
Of course, higher interest will dampen growth of the real sector or of the entire economy, because it's less liquidity, there's less access to it. So the real sector will not expand as much as it would want. The economy may not grow as fast as it wants to, because liquidity is difficult to access, credit is difficult to get. So that might not really be good. But if you look at it on the flip side, is that the central bank is trying to tackle inflation. Inflation also has its own happening impacts on the real sector and on the economy. So it's a balancing act, which is quite difficult for the central bank to actually embark upon. I remember the president of the Dangote Group, Aliko Dangote, was complaining about the high interest rates. And then they had not even added 50 basis points that were added just yesterday. And if you look at it, he is complaining that it's difficult to get job in an economy where the rate of interest is very high, and that is destroying businesses. But high inflation is equally destroying businesses, it's equally destroying livelihoods. So it's a balancing act. The central bank will not just be hiking interest rates if inflation was not high. In fact, we're having negative real interest rates. It's negative in the sense that our inflation rate is way higher than our lending rate, way higher than our interest rate. So that's not even for the economy. So it's a balancing act. And as soon as this inflation is tackled and inflation is within manageable level or is on target, I believe the central bank will not have any justification whatsoever to hike interest rates. So we have to look at the job of balancing between trying to reconcile tackling high inflation and making sure that credit is available for the real sector. The fiscal authorities have tried to compensate for that. I was reading recently the Minister of Finance, Mr. Wale Edu, saying that they have actually released more than 1 trillion naira to the sector. I'm not saying that enough, but at least something has been done, something has been done. So there's a lot of things that have to be done. The problem of inflation is inflation can actually be very destructive to businesses, can be destructive to livelihoods. And I think everything must be done to tackle it. So far, we have not seen results, but that does not mean that whether the fiscal authorities or the monetary authorities should relent with their efforts.
Let us talk to the impact of this change on the fixed income market. How will the fixed income market be affected, and what should fund managers consider, especially with the current economic climate?
Well, with this, the central bank is trying to attract investments, particularly foreign investments, because of the positive of forex. It was a problem for us, and we're not fully out of it. So the fixed income market, whether you're talking about treasury bills or you're talking about bonds, with the higher interest rates, that will be higher returns for people that are into that market. And people will be running away from the fixed market, the fixed income market. So it's an attractive investment because yields will be higher, what you get from those investments become higher.
But you have said over and over again, the inflationary pressure that we are currently facing in Nigeria, but there hasn't been, so much changes. And you've highlighted, the causes of this particular inflationary pressure we are facing. But are we considering other options at this point? It seems as though the CBN is using, one particular measure towards tackling inflation. But what other measures could be put on the table towards addressing the current inflationary pressures that we are facing?
I think if people want to CBN has very aggressive. It has deployed as many tools as possible. There has been a flurry of policies and all in the bid to tackle inflation. And even the aggressive hiking of interest, that also is even tinkering with the asymmetric corridor. You look at the liquidity ratio, cash reserve ratio, all of them have been increased over time. So the central bank has done more than its fair share. But there's another problem, and which is one of the reasons why we're in this country. Ways and means. Ways and means was abused over so many years, and we're still suffering from it. I think the central bank governor alluded to that when he was leading the public yesterday. And I think if there is a way we can even stop ways and means, is a noble thing. It was initiated as a backstop to government spending. Sadly, it was abused in the past, and the probability of it being abused now is still heavily there. If there is a way we can stop this abuse entirely. And another angle to it is that the federal government is trying to have a window of food being imported. If you look at our inflation, it's largely food driven. So if we have other means, and what the fiscal authorities were trying to do was to buy food within the Nigerian market, thereby making it worse for people, for you and I, go to the market because of so much money that they are going to pump into that. But now that they have agreed to import, I think that will help. I know some people are skeptical, including the president of the African Development Bank, that will kill agriculture in Nigeria. But I beg to differ. We have deficit. If you take rice, for example, we consume 7 million metric tons, we produce 4 million. So there's nothing wrong with getting the deficit elsewhere.
Let's go on a short break. The conversation continues after the break. Just stay. You're still watching Business Daily on Trust TV, and my guest is still here with me. I have still with me Dr. Samson Simon, who is an economic analyst. Doctor, you were speaking to alternative ways that the CBN could inculcate towards nipping inflation in the board. Can you continue with your thoughts, please?
Yes, I was talking about the central bank governor yesterday, alluding to the fact that when the fiscal authorities were trying to meet the monetary authorities halfway and they went into the Nigerian markets to buy foodstuff, that really crowded out everybody. And I think the fiscal authorities have learned from that, and they're trying to embark on the importation of food. I know many people are kicking against that, including the president of the African Development Bank, that might destroy the gains in the agricultural sector in Nigeria. But I beg to differ. Let me pick just one commodity, rice. We consume 7 million metric tons of rice. We produce 4 million metric tons. There's a deficit of 3 million metric tons that we cannot produce overnight. So there's nothing wrong with importing the deficit. And this is just a stopgap measure. Because if you look at our inflation, it's driven by the headline inflation, is driven by the food component. So everything must be done to bring down food inflation. I'm not saying that we have to embark on importation in perpetuity, but a stopgap measure. And we need to tackle some of the problems around food. What are these problems? Insecurity. That is not within the remit of the central bank. The fiscal authorities should do everything possible to tackle insecurity within the Nigerian nation. Another thing that we need to work on is that our farm inputs, we need to get improved grids. We need to get affordable farm inputs. Those things will go a long way. And then our yield is very low, is miserable. There's a need to improve it. And one way of improving it is by mechanization, tractorization. And I think the central bank has done its own bit. Sadly, it tried to do all these things in the past, and it has not yielded much. We remember the Anchor Borrower Scheme. So I don't think the central bank should go into an area that is not an authority on. It can work alongside the fiscal authorities to fix this problem. And then ways and means, if you ask my opinion, it has done more harm than good. I know it was created to benefit us. It was created to benefit the Nigerian economy. Should we have short-term financial difficulties? The central bank was meant to serve as a backstop, ways and means. Sadly, it has been abused, and the possibility of it being abused is everly there. So everything must be done, if possible, to stop ways and means, because it has put us in this mess. And if we are not careful, we may resort to it again and to compound our problems. So these are some of the suggestions that I have.
But do you foresee another interest rate hike this year, say before the end of 2024?
Well, the possibility is there because inflation is still elevated. Inflation is still climbing. So the central bank will likely embark on more hikes. But if you look at it, it has moderated From 400 basis points, it went to 200, it went to 150, then to 50. So it's moderated. So we should not rule out hikes in future. It may not be as aggressive as we have seen before, but the possibility of hikes cannot be completely ruled out. And if you look at it, there's no harm in hiking. Though the central bank also has to be conscious in the sense that monetary policy has long and a variable lag. So sometimes you just hold and watch what you have actually hiked to see the impact, instead of just aggressively hiking without waiting to see the results of these hikes.
What about inflation? Of course, we are aware of the policy of the 150-day window for importation of certain food produce, without taxes. But do you foresee this impacting on food inflation, dousing food inflation specifically, and reducing inflation as a whole, the inflation rate in the coming months? What are your expectations for inflation?
Inflation may likely moderate too, because we are approaching the harvest season. And I can cite an example for you: Irish potato. For Nigerians that like taking local Irish potato, what was the price 2 or 3 months ago? What was the price now? A tiny fraction of the price. Why is it so? Because of the bumper harvests at the producing areas in Nigeria, particularly in Plateau State. And we are approaching a point, which is going to be in August, where the entire market will have a surfeit of such a commodity. And the same thing can be replicated with other commodities. If we should have bumper harvest, that will bring down food inflation, and by extension, the headline inflation. Therefore, the core inflation, I think this Dangote thing, we need to do something about it. We need to encourage local production, domestic production, particularly if it's going to cost us less. The unit of this commodity is going to cost less to the Nigerian consumer. So if this energy cost will be brought down, if food prices will come down because of bumper harvest, then inflation will likely come down. Though the target that the central bank set for itself at 21.4, I think is very unlikely for that to happen. But we are likely going to see less inflation before the end of the year.
Before we go, I would like to hear from you what your assessment of the current business climate in Nigeria is, especially looking at it from an international point of view. Would you say that these inconsistent policies just might send the wrong signals to international investors, or what are your thoughts on that?
Can you repeat the question, please?
No, I'm talking about the current investment climate. How would you've mentioned the Dangote issue that has gone on recently, but putting all of this together now, how would you say these, or what kind of messages or signals is this sending to the international investment space?
I think it's not really good for Nigeria, and it will just boost negative investor sentiments. Any investor will be skeptical about coming to Nigeria. It portrays us in bad light, and the government should not try to fuel this. It should not stoke this. If there is a way it can reconcile and find a way to support businesses, whether domestic or even foreign, because foreign businesses also employ Nigerians, also grow the Nigerian economy. So everything must be done to boost investment. And there's this popular thing. We know our leaders like traveling around the world looking for investors to come in. That may not be necessary if we do all the right things. There is this popular thing, Nigerians like to go to the UAE or Dubai to invest. Sheikh Maktoum did not come to Nigeria looking for investors. But Nigerians realize how friendly, investment friendly and business friendly the UAE is, and they're all trooping there. The same thing can be applied for us. If we need investors to come in, then we have to improve our investment climate, we have to improve our business climate, we have to prove to the world that we're open for business and it's good for them to come in and do business with Nigeria. But with the Dangote case, I think it's portraying us in bad light, and everything must be done to nip it in the bud.
Thank you, Dr. Samson Simon, for all the insight you have shared today on the program.
Thank you for having me.
This is where we draw the curtains in today's edition of Business Daily. But join the conversation on social media and let us hear your thoughts on the discourse for today. My name is Chiamaka Enendu. Thank you for watching and bye for now.